$21 trillion. Write it out in full. 21 followed by 12 zeros. It takes a moment just to count the digits. It is a number so large that the human mind, accustomed to thinking in thousands and perhaps millions, has no honest intuition for it. It is 3/4 of the entire annual economic output of the United States of America. The sum total of every good produced, every service rendered, every hour of labor sold in this country across 9 months. It is enough money, if converted into the median price of an American single-family home, to purchase every house in the country. Every bungalow, every farmhouse, every brownstone, every suburban colonial from Maine to Hawaii, and still have change left over. Now imagine that this number, this incomprehensible civilization scale sum, is not an asset. It is not a budget. It is not a fund. It is a gap, an absence, a void in the ledgers of the United States federal government where accountability should be. A series of transactions, movements, transfers, and adjustments inside the books of the Department of Defense and the Department of Housing and Urban Development that cannot be explained, cannot be verified, and in many cases cannot even be traced. Not missing in the way a wallet goes missing, missing in the way a ghost is missing, present as a disturbance in the record, leaving marks everywhere but impossible to hold. This is the story of how $21 trillion in unsupported accounting adjustments came to exist inside the machinery of the American government. It is the story of the legal architecture that protects that gap from scrutiny. And it is, most fundamentally, a story about what happens to democracy when the financial organs of the state stop being legible to the public that funds them. On the 15th of November 2018, something happened that had never happened before in American history. The Department of Defense, the single largest discretionary budget item in the United States federal government, commanding over $700 billion per year, completed its first ever agency-wide independent audit. It failed. Not narrowly, not on technicalities. The auditors, a consortium of independent accounting firms, issued what is known in the profession as a disclaimer of opinion. In accounting, opinions come in gradations. A clean opinion means the books are accurate and the auditors can stand behind them. A qualified opinion means there are concerns, but the overall picture is verifiable. An adverse opinion means the books are wrong. But a disclaimer of opinion is something else entirely. It means the auditors could not gather sufficient evidence to form any opinion at all. It means the books were so incomplete, so fragmented, so internally inconsistent that it was impossible to determine whether they were right or wrong. This is not a failure of accounting, it is a failure of accountability. And the scope of that failure was staggering. Components of the Department of Defense representing approximately 90% of its budgetary resources received this disclaimer of opinion. 90%. The Army, the Navy, the Air Force, the Defense Logistics Agency, the agencies managing contracts worth hundreds of billions of dollars, the supply chain sustaining a global military presence, the financial systems through which the largest employer in the world conducts its operations. None of it could be verified. The auditors walked away without answers. Officials at the Department of Defense described the audit as a learning experience. A first step, they pointed out not incorrectly that government accounting systems are complex, that data is siloed across legacy infrastructure built over decades, that military operations create unique financial challenges. These things are true, but they are not in themselves a sufficient explanation for the scale of what the auditors found. Because the problems the 2018 audit exposed were not new. They had been accumulating, unaddressed for a very long time. To understand why, you need to understand a legal instrument that most Americans have never heard of, and that even most financial professionals would struggle to locate. you need to understand Statement of Federal Financial Accounting Standards number 56. In October of 2018, the same month the Department of Defense audit was concluding its initial work, the Federal Accounting Standards Advisory Board issued a new accounting standard. The Federal Accounting Standards Advisory Board is the body responsible for establishing accounting principles for the United States federal government, the public sector equivalent of the Financial Accounting Standards Board that governs corporate reporting. Its standards are not suggestions, they carry the weight of law. Statement of Federal Financial Accounting Standards. Number 56 amended the existing framework governing federal financial reporting. Its stated purpose was to clarify how agencies should handle classified information within their financial disclosures, a genuine and long-standing bureaucratic challenge. When an intelligence agency spends money on a covert program, how does it report that spending without compromising the program's existence? This is a real problem, and the government has wrestled with it in various ways for decades. What Standard 56 did, however, went significantly further than clarification. The standard contains a provision, found in paragraph 9, that allows agencies under specific circumstances to modify financial statements before they are made public. Not redact, not omit, modify. The standard explicitly permits what it calls modifications to reported line items, meaning that figures in public financial disclosures can be changed from their actual values to different values. It further permits the shifting of funds between reporting entities, effectively allowing money to be moved from one agency's books to another's, in order to prevent the disclosure of classified activities. To be precise about what this means, Standard 56 creates a legal mechanism by which the publicly reported financial statements of federal agencies need not reflect the actual financial position of those agencies. The reported numbers can be different from the real numbers. And this is not fraud. It is not a violation of the law. Under Standard 56, it is the law. The standard does contain constraints. The modifications must be approved at the highest levels of agency leadership. The actual unmodified statements must be maintained and made available to oversight bodies, in theory. And the scope of the modifications is supposed to be limited to genuinely classified activities, not used as a general license to obscure inconvenient figures. But here is the structural problem that legal scholars and government accountability experts have raised since the standard's adoption. There is no external verification mechanism. The decision about what qualifies as a classified activity requiring modification is made internally by the same agencies whose finances are being modified. The unmodified statements are classified, meaning they are not available to the public, to Congress in any meaningful deliberative capacity, or to the press. And the Government Accountability Office, the congressional watchdog whose mandate is precisely to verify that government money is being spent lawfully, has itself acknowledged the extraordinary difficulty of auditing agencies operating under this framework. What Standard 56 created, in effect, is a legal architecture for financial opacity, a framework in which the government's books can be, by design and by law, something other than true. It is worth sitting with what that means. Financial reporting exists for a reason. In the private sector, it exists to protect investors and creditors, to ensure that the people providing capital to an enterprise have an accurate picture of its health. In the public sector, it serves an analogous but deeper function. Citizens are not investors in the voluntary sense. They are compelled contributors whose money flows to the federal government through taxation. And in exchange for this compelled contribution, they are owed, as a fundamental condition of democratic legitimacy, an honest accounting of where that money goes. Standard 56 creates a category of government spending that is exempt from this obligation, It creates in formal accounting language what can only be described as a legal misstatement. And it does so not as an emergency measure, not as a narrow and carefully scrutinized exception, but as a standing framework built into the foundational accounting standards of the federal government. The story of how the $21 trillion figure came to light is, in many ways, a story about what investigative journalism and academic research look like when the normal tools of financial disclosure are unavailable. Dr. Mark Skidmore is an economist. He was, at the time he began this work, a professor at Michigan State University, where he taught public finance and state and local government economics. Not, in other words, a figure from the world of defense contracting or intelligence oversight. What brought him to the question of federal accounting anomalies was not a whistleblower or a leak. It was a broadcast. Skidmore's first reaction, by his own account, was skepticism. The numbers seemed too large to be real, and too large to have escaped general notice. The total authorized Army budget for that fiscal year 2015, was approximately $122 billion. The unsupported adjustment figure being reported was $6.5 trillion. That is not a rounding error. It is not an accounting quirk. It is a figure 54 times larger than the Army's entire authorized budget for the year, appearing as an adjustment in the Army's books with no documentary support. Skidmore and a team of graduate students began reviewing Inspector General reports systematically. These reports are public documents. They are posted on agency websites and are technically available to anyone. But they are also dense, technical, and written in the specialized language of government accounting, which makes them largely impenetrable to anyone without specific expertise. The Inspector General reports are not, in other words, documents that journalists routinely read. They are not documents that generate headlines. They exist in a kind of informational gray zone, technically public, functionally invisible. What Skidmore's team found working through these reports methodically was a pattern. Beginning in the late 1990s and continuing through 2015, both the Department of Defense and the Department of Housing and Urban Development showed, year after year, enormous volumes of accounting adjustments that were unsupported by documentation. Transactions were recorded without explanation. Funds appeared in accounts without traceable origin. Transfers occurred between accounts with no corresponding entries. The numbers fluctuated year to year, sometimes sharply, but the phenomenon persisted across administrations, across fiscal cycles, across changes in agency leadership. When Skidmore's team totaled the unsupported adjustments across both agencies for the period from 1998 to 2015, the cumulative figure they arrived at was $21 trillion. The paper was published. It received some coverage in specialized publications. Catherine Austin Fitts amplified it through her own channels. But in the mainstream of American financial journalism, it generated remarkably little sustained attention. A number this large, suggesting a phenomenon this serious, moved through the news cycle and largely disappeared. The reasons for this are worth examining. Part of it is the nature of the material. Accounting anomalies are difficult to translate into narrative journalism. Part of it is the complexity of the distinction between what these adjustments are and what they are not. A distinction that is absolutely essential to understand clearly. $21 trillion in unsupported accounting adjustments does not mean that $21 trillion in cash has been stolen from the United States Treasury. This point is crucial, and it must be stated plainly because the distinction, while real, does not diminish the seriousness of what these figures represent. It merely changes the nature of the problem. An unsupported accounting adjustment is an entry in a financial ledger that cannot be traced to underlying documentation. In normal accounting practice, every entry has a source A contract, an invoice, a transfer order, a payroll record. Some document that explains why money moved or why a figure appears where it does. When an adjustment is unsupported, it means that explanation is absent. The number exists in the book. The book says it is real. But when an auditor asks to see the documentation, there is nothing to show. This can happen for a variety of reasons. It can reflect genuine errors, data entered incorrectly, systems that don't communicate with each other, legacy databases that were never reconciled. It can reflect accounting methodology decisions that were poorly documented. And it can reflect something else: deliberate obscuration. The movement of funds through accounting systems in ways designed to make them difficult to trace. The critical point is this: whether the cause is error, poor systems, or deliberate obscuration, the outcome is identical from the standpoint of public accountability. The money cannot be verified. The books cannot be trusted. And when you cannot trust the books, you cannot know what the money was spent on, where it went, or whether it was spent in accordance with the law and the appropriations Congress authorized. That is the true meaning of the $21 trillion figure. Not that $21 trillion is gone in the sense that someone spent it on something, but that $21 trillion worth of transactions in the books of the federal government cannot be accounted for, cannot be explained, and cannot be verified by any external party. The money, or rather the record of the money, exists in a space beyond accountability. And here, the scale of the analogy becomes important again. $21 trillion, 3/4 of American annual GDP, the total value of every residential home in the United States. This is the volume of federal financial activity that, by the evidence of the government's own Inspector General reports, has passed through the system without adequate documentation over a 17-year period. What are the implications of this? What does it mean in practical terms when 90% of the Defense Department's budgetary resources cannot be verified by independent auditors? The first implication is about congressional oversight. The United States Constitution vests the power of the purse in the Congress. Article 1 is explicit. No money shall be drawn from the Treasury except in consequence of appropriations made by law. The entire theory of congressional authority over the executive branch rests on this principle: that because Congress controls the budget, it controls what the government can do. If the executive branch cannot account for how appropriated funds are actually spent, or if the accounting frameworks it operates under legally permit the modification of reported figures, then the congressional power of the purse is not eliminated, but it is substantially hollowed out. Congress appropriates, but it cannot verify. And an appropriation you cannot verify is, functionally, a blank check. The second implication is about the concept that government accountability experts call a shadow economy. This is not a metaphor. It is a description of what happens structurally when a sufficiently large volume of financial activity operates outside the normal architecture of accountability. When money moves without documentation, when financial statements are legally permitted to diverge from reality, when the institutions responsible for oversight cannot access the underlying data, the result is a financial ecosystem that runs parallel to the official economy. It has its own logic, its own flows, its own purposes, and it is, by design, invisible. The phrase shadow economy is usually applied to illegal activity, the underground market, the black market, the cash economy that exists to evade taxes and regulations. What makes the phenomenon described here so troubling is that it is not clearly illegal. It operates under legal frameworks. It is authorized by accounting standards. The shadow economy of the federal government is not a criminal conspiracy hiding from the law. In important respects, it is the law. The third implication is about institutional trust. Democracies run on a form of social contract. Citizens pay taxes, obey laws, and participate in civic life, and in exchange they receive, among other things, a government that is accountable to them. The mechanism of that accountability is, in large part, financial. We can see what the government spends. We can evaluate whether that spending reflects our priorities. We can, through our elected representatives, question and challenge and ultimately control the flow of public money. When that mechanism breaks down, when the books cannot be read, when the adjustments cannot be explained, when the auditors return a disclaimer of opinion on 90% of the largest agency in the federal government, something fundamental has been lost. Not necessarily through malice, not necessarily through crime, but lost nonetheless. Trust once eroded is extraordinarily difficult to rebuild. And the erosion happens not only when people learn about specific failures, but when the system itself demonstrates that it does not consider transparency to be a non-negotiable obligation. It is worth asking finally what this story is really about at its deepest level. Not the mechanics of accounting, not the specifics of any particular Inspector General report, but the underlying question of power and its relationship to legibility. Power throughout history has always sought to make itself unreadable. Not because powerful people are uniformly malicious, though some are, but because opacity is, structurally, an advantage. An institution whose finances cannot be traced cannot be held accountable for how it spends. An agency whose books are legally permitted to diverge from reality cannot be meaningfully controlled through the normal mechanisms of democratic governance. A budget that auditors cannot verify is a budget that exists in important ways outside the social contract. The systems we have examined, the disclaimer of opinion, Standard 56, the architecture of unsupported adjustments, are not aberrations. They are the product of choices. Choices made over decades by people in positions of authority to build financial systems that prioritize the operational convenience of executive agencies over the accountability obligations those agencies owe to the public. Whether those choices were made in good faith, in the genuine belief that national security required this level of financial opacity, or whether they reflect something less principled is, in some sense, a secondary question. The structural outcome is the same regardless of intent. A government that cannot be financially audited is a government that cannot be fully democratically controlled. What the $21 trillion gap represents in the end is not just missing documentation. It is missing accountability. And accountability is not an administrative nicety. It is not a bureaucratic formality. It is the mechanism through which a democratic society retains meaningful sovereignty over the institutions it creates and funds. When accountability disappears, when it is legislated away or bureaucratically buried or simply rendered impossible by the complexity and opacity of the systems through which public money flows, something irreplaceable goes with it, not money, something more fundamental than money. Power without accountability does not stay still. It does not wait to be reclaimed. It moves quietly and continuously away from those who are owed it and toward those who have the means and the mandate to keep it invisible. 21 trillion reasons suggest that this process has been underway for a very long time.